Hey everybody, Doc Severson here with you. Trade School today, Friday, the 25th of October. Welcome aboard, everybody. We're doing something a little bit different today. We're going to host a public trade school. Normally, this is something that is private only to our Omnia customers. We thought we'd open it up a little bit today, have a little fun on a Friday in late October as we close in on Halloween. How's everybody doing out there today? Hopefully everything is working okay. You can hear me all right. And of course, welcome aboard to our Omnia members. And I'd also like to shout out to anybody that's just watching this on a replay. A lot of times you guys don't have the time to watch these things live. You tune in later on a replay. Pretend like it's live, okay? If you have any questions as it comes through, what I'm going to do here today is I'm going to cover the questions that were supplied to me by the Omnia members that they wanted me to cover today in Trade School. You'll see what those questions are in a minute. And then I will open it up to the crowd. So hope everybody is doing okay. Welcome aboard, everybody. And hello, let's get started. Okay, so what I'm going to do is I'm going to throw myself down into the lower left-hand corner in purgatory down here. And if that gets in the way, let me know. Otherwise, we will continue here. All right, today's trade school, what are we going to talk about? First of all, let's get the lawyers out of the way. We don't need this. Today's topics, what we're going to cover, examining the current market and polarity. So that, let me decode that for a lot of you. What we're looking at is in terms of the polarity of the market. Is it in an uptrend? Is it in a downtrend? A lot of that depends on your point of view. And we'll take a look at all angles today and see if we can figure out a conclusion from that. I also want to talk about setting the forward expected moves for this. Now, again, this may be Greek to a lot of you, but this is what we can do with options. And if you've never had any experience with crypto options before, something very interesting is that we can actually use the analytics that are part of the option chain to sort of set these statistical forward movements of it. It's a way to predict the future in a way that's only available through options. All right, we got Texas and East Tennessee online. Welcome aboard, everybody. Good to see everybody out here on a Friday. Then we're going to go into the one of the questions that came up was implied volatility based option entries. Okay, something kind of interesting. I didn't even know that existed until this morning. Then we're going to talk about managing options exits. So a lot of these are options related questions right now, just because I gave a class on options a couple months ago and people are still working through that. Trust me, 15 years later, after my exposure to options, I'm still working through a lot of things in options. It's one of those never-ending discoveries. And then we'll talk about setting Deira Bet perpetual contract exits. And I took a position this morning in there, and hopefully it's still live so that we can take a look and see what the options are for setting up futures exits. So like I said, if there's any questions, what I'm going to do is I'm going to make sure that we take care of the Omnia people first and take care of their questions. If there's any other questions that comes in at the end of this session, then I will certainly entertain those. So we'll be here for maybe half an hour, 45 minutes or so to take care of this, and then we'll get you on your way here on a Friday. Hello, Tony from Italy. Good to see you on board. So where's the market heading? Everybody wants to know this. Everybody wants to speculate on the future of the market and where it's going and what's going to happen. And I suppose when we say the market today, we still have to say Bitcoin. We still have to say Bitcoin is the market until it yields its dominance right now. So goes Bitcoin, so goes the market. So a couple of things that we can look at here is the monthly log chart. We can look at the larger time frame fractal array, and then kind of dive down into the daily chart and see where that's going. Okay, so let's do this. Let's get into the chart. Okay, so this is BTC, and what I'm going to use is Bitstamp because Bitstamp has got a nice long history on Bitcoin, and this is actually important for us to do that. All right, Crypto Valley, Rocky Mountain High in Colorado. Welcome aboard, guys. Good to see everybody. So one of the things that we've been looking at, sometimes you lose the forest for the trees if you're just too narrow. I mean, A lot of people are going down to a little tiny chart like this. Ooh, I think I'm out. I think I'm out. Hang on a second here. I want to, and that's unfortunate because I wanted to see, oh, I'm still in. I'm still in. Okay. I think I'm still in. Let's see if we have trade history. I'll be darned, I'm still in. Still have an open order. Oh, look at that. The price is 7,750, and it got right up to there. And it got right up to there. We're going to come back to this in a minute. And look at this. It's just, I had an order sitting up here, and I thought that by now I'd be filled, but we'll see. It may actually throw a little emblem up here if I do get filled. So that'll be kind of fun to do this live. All right. Focus, focus, stay on target, stay on target, loosen up. Okay, so here we are looking at Bitcoin on the daily chart. One thing that I see this from time to time out there, and that's a log chart. If we're going to do a log chart, what a log chart does is it shows the vertical axis based on percentage instead of a linear log chart. And this is what it produces. Now that's a very different way to look at what's happening in Bitcoin. You can see that this massive move here from 230 all the way up to close to 20,000. And we had our own little move here. But something I want to show you guys is sometimes markets have a very strong sense of repeating patterns. And so what I want to do is I want to measure this move from the top over here to where this thing really took off. All right, so if we measure this box here, and this was the last bear market that we went through back from 13 to 15, it took 23 months, almost 2 years, 699 days is the way that we measure this. And again, we're working within the context of a month here. So that's how long it took for this thing to really start to lift and really move and print higher highs and higher lows. 699 days, 23 bars. Let's do the same thing over here. Okay, so we're going to go from here over to where we are right now. And I'm going to push it forward a month. And there we go. 23 bars, 700 days or 699 days, whatever you want to call it. So we're like 1 month shy from equaling the last bear market. And when the last bear market really started to escape of this, because if we sit there and say that this is just one large consolidation pattern, then perhaps we're still within the realms of normality here. Plus we can, we've got this nice trend line in play here on the log chart. Is this more important than the linear chart? I don't know. I mean, it certainly does give you a different perspective on things. And sometimes, again, like I said, you can lose the forest for the trees by getting into the linear time frames and smaller time frame charts, and you get so focused and myopic in terms of what's going on that you lose the bigger picture. So to me, the log chart has got the biggest picture. I mean, we can do the log chart on something like, let's see if we can do the here's the S&P 500 going back in the log chart for like forever, right? We can do this. And this helps normalize all the volatility. And this goes all the way back into the 60s and, back into 1872. If we didn't have this log chart, this last push here would be way off the charts because of all the quantitative easing. But log charts are very important if you want to zoom out your view and take a look at things differently. Okay, so let's go back to where from whence we came. Let's get off of the log chart. I'm going to reset this chart. And now what I want to do is I want to just go out and look at the chart from a weekly perspective. We're getting a nice tail today. I like this tail that we're getting today. This is good. All right, so one thing that we can also look at this is when we zoom out to the weekly chart, we can look at fib retracements. So if we look at the entire move here from the very bottom up to the top, Where did the price come down to? The price came down to exactly the 61.8% retracement. Now this to me is kind of like the last line of defense. Typically when we break through here on a closing basis, if we break through there, then typically we fill in the triangle. The probabilities are increased that we fill in the triangle, which nobody wants to see. Nobody wants to see us go down to 3,300 except for one individual that I can think of. So let's watch this area carefully. Now, to me, I think there's another target which goes down here. So I'll tell you what, I'm going to get rid of all the fibs here. We don't need the fibs on here right now. And what I'm going to do is I'm going to bring up volume profile. So volume profile tends to be pretty accurate in terms of watching the price. When there's low volume profile, that means that there's no support and resistance. It just, price can just plunge or rise right through there like it just didn't even exist. But the price will tend to get hung up around these areas here. And this is why I felt way back here when the price was in here, first of all, we were saying that everybody's looking for the price to break out. So I was looking for the price to break down because I've learned to be contrarian about things. When everybody sees the same thing, it usually will move in the opposite direction. So now we may be getting to the point where everybody's getting bearish. And I would love to see a high volume flush down here. And that's going to be, whether it's the daily or the weekly chart, that's going to be signified by a big hammer candlestick that's going to look something like this. A big kind of a V bottom kind of thing. Okay, but what you'll find is that the volume profile will signify support and resistance in this type of market. And we still have this big volume profile back over here at 6,500. That will come into play. That will come into play if the price gets down there. So a lot of people have been asking me, is the price going to get down there? I have no idea. There's no way that I can look forward. And I would say anybody that has a very hard prediction about where the price is going to go, more than likely is just looking for clicks for their channel. Nobody knows what the future is going to be, guys. So what you can do is you can build out your framework for what might happen if the price gets down to an area. So to me, if the price gets down to 6,500, I would expect to see some type of bounce in there. I would expect to see some type of demand coming into there just based on volume profile. All right, we got somebody, Mark is on a train between Stockholm and Gothenburg. Welcome aboard. That's awesome. You have internet out there. Okay, so that's kind of my look at the market right now. Is like right now it's definitely in a downtrend, but in the context of things, it's still in an uptrend, right? So it depends on your point of view as to which of the way market is going. Right now, I would say for us to go higher in the near term, we have to go lower first. That's the way that markets go. You've got to get too many people on the wrong side of the ledger. You've got to get them committed. You've got to get them overly confident with way too big a position size. And then they've got to be scrambling to get out. That's the way the price moves. Price doesn't move just based on, it's not like this day-to-day supply and demand, you know, kind of like, well, I think it's undervalued, so I think I will bid it higher. And oh, by the way, I'm going to use a limit order, which is not going to move the price at all. The way that price moves is when people are plunking down market orders, like get me the hell out right now. Get me out right now. You guys have all been through that before, right? You know, where you're like in a position, all of a sudden the price is like flying back in your face. And you're like, get me the hell out of this thing. That's how price moves. You got to get too many people on the wrong side of the ledger. So right now, we've got to get the bears completely and totally committed to thinking that the price is going to go down to zero. So keep talking up the downside. Keep talking up the downside. Okay, so let's move on here. Let's move on to our next thing here. All right. The next thing that we have is setting the forward expected move probability cone. I think you guys will find this interesting. If you haven't been through this before, if you haven't seen anything like this before, if you don't have any experience with options, I think you'll be a little bit surprised. And I think this will put a different tool in your tool belt to look forward at where price is going. So this all depends on, oh, it's so close. It's right up there. I wonder if I actually did get, see if I did get filled on this. Oh, 0 open orders. I got filled. So this is going to make a lousy example when I get to the futures at the end of this. But, so we'll get back to this. What I'm going to do is I'm on Deira Bet right now. And let's go full screen. How would you like to know between now and the end of the year, so let's say 27 December, which is close enough to the end of the year, would you like to know what the 68.2% distribution of prices is going to be? So plus and minus, what's a 68% probability of the price being higher than that or lower than that? What's the range? So the way that we do that is to pick an option chain. And so we're going to pick an option chain here. I'm going to pick the 27 December. And this is all based on how the options are bid up and sold and things like that. So what I'm going to do is I'm going to pick the strike price that is closest to us here. And this is going to freeze the screen for a second. And what I'm going to do is a little bit of math. And so what we have to do is come up with an average between this price and this price. Okay, so I'm just going to do this really quickly here. And some of you can probably do it faster. So I'm going to do 935 and 969. And so this is going to be 952. This average is going to be 952. I'm just looking for the rough midpoint between these two. And then we've got, on the put side, we've got 711 and then 745. And that's going to be 728. What we want to do is we want to add these two numbers together. So 728 and 952 is going to be 1680. 1680 is our expected move. This is a very rough approximation. So it's going to be plus minus 1680. Let's go back to our chart. I'm going to mark this down before I forget it. Let's go back to our chart and put up the probability cone for this. Back to the charts. Okay, so here is, I'm going to stay with Bitstamp. And I've got this expiration date already marked out. I've already got it marked out for the end of December. So what we talked about was, okay, the current price is, what is the current price? Is yes, let's just say it's 7,700. Let's just say the current price is 7,700. And that's pretty close. That's pretty close. Okay, so 7,700 minus 1680 is 6020. So I'm going to move this up to 6020 down here at the bottom. And then 7,700 plus 1680 is 9380. 9380. Okay, that's close enough. Let's get that. 9380. There we go. All right, and so let's change this to where the price is right now. And there is our probability cone. there's a 68.2% chance that the price is going to be inside of this cone, 68.2, and this is our log normal distribution of probabilities. Now the price can do whatever it wants to do, but what you'll find is that sometimes you'll see people trading based on these levels. And so sometimes if the price gets up to there, you'll see it actually fade from that level as resistance, or the price gets down to there, you'll see the price actually pop up. So we definitely see this in the equity markets where everybody knows what the expected move is going to be. And so it does come into play from time to time. But you know, when you see people on the internet, you know, making predictions about, well, the end of the year, it's definitely going to be 20,000. Why don't you do it this way? Why don't you say, well, you know what? My sense is that based on the supply and the demand of the options out there, I'd say there's a 68% chance it's going to be between 6,000 and 9,300. And all of a sudden you start to sound a little bit more intelligent than everybody else wailing out there. And so what you can do with this is you can set up option positions. You can maybe say, well, I'm going to sell something down here, which has got a higher probability, or maybe if you've already got an asset, you can rent out your Bitcoin and sell calls above this area with a little bit more safety. There's all kinds of things that you can do once you know the expected move going forward. How do you get that cone thing? Okay, the cone thing, let's see, I'm trying to remember where I found this. It's in one of the geometric shapes. It's down here in the arc. But the way I calculated the cone probabilities is to go over here. The way you calculate this, and this is what I've been doing in the Omnia room the last couple of days, is what we're going to do is we're going to find the strike price. Let's go with a different color here. We're going to go with the strike price. First of all, we're going to pick when we care about this time frame, number one. Number two, we're going to pick this option chain for 27 December. And then we're going to say, all right, what's the closest strike price to at the money? It's going to be about 7,500. And then what we're going to do is we're going to calculate the straddle price. And so what I did was I kind of came up with an average between the bid and the ask, which is about the midpoint. And what you're going to do is sum these numbers together. The at the money straddle price gives you approximately a plus minus 1 standard deviation forward projection for the price going forward, which is a hell of a lot more than anybody else is going to give you in terms of a forward projection for the price. Okay, thanks, Tony. Sorry for the replication there. So again, this was in the trade scroll from 2 weeks ago. So for you Omnia members, if you want a little bit more detail on it, it's in the archive. It's in the archive. So back to the cone. We've got the cone of shame here. There we go. So that's, again, 68.2% probability. Now you can also, that's one standard deviation. You can also calculate 2 standard deviations if you want to. There's all kinds of ways that you can use this. So typically it's used for like placing positions. So one of the things with crypto right now, there's not much that we can do in terms of advanced option strategies just because the interfaces are so kludgy. But you know, once Eris X and maybe even Backed gets into this with a better interface, we'll be able to set up things like vertical spreads below here that are great for small accounts. So there's all kinds of things that we can do for this. We're very early into the world of options in crypto. The acoustics suck. Well, I apologize for that. Yeah, this is, I've got a 19-foot ceiling in here with concrete floors, and there's not a hell of a lot that I can do about it. So unless I want to go out and get like 14 yards of foam and make this place look like an egg crate, sorry about the echo. Okay, so let's move on, shall we? Let's move on. Okay, so we set the forward expected probability cone. All right, so I got a question over the last couple of days of implied volatility based options entries. So one of the things that we've been talking about to our members is implied volatility basically measures the amount of fear and forward volatility going into the market. And if we want to, two standard deviations, we can just throw the Bollinger Bands on there if we want to. But that's a lagging thing. So what we want to do is we want to be selling options when implied volatility is high. Just when everybody else is freaking out, this is when we want to be selling options. We don't want to be selling options when implied volatility is very complacent. And frankly, it is right now. It's fairly still complacent. Okay, so we want to be selling it when it's relatively high and then buying it when it's relatively low. So a question came in, can we set a forward entry? Can we just set a limit order and wait till we get some kind of big implied volatility entry? Well, yeah, we can, but let's take a look at that. Okay, so what we can do with this, so let's just say we're going to enter an option here and we want to sell the $6,500 strike puts. And so what I'm going to do is I'm just going to click on this and bring up the order entry. And this is called the complex order form. This is Deira Bet. This is Deira Bet, which is based in, I think it's Belgium or the Netherlands. I haven't been on LedgerX for a month or so. I don't think that this capability is with LedgerX. So we can set up a limit order based on either BTC price or dollar price, or we can also set it up based on implied volatility percent. So right now this is set for implied volatility of 67.7%. So what does that mean? Well, this is if you look at this on the chain, we can actually bring up implied volatility. And right now these are actually relatively low. These are relatively low. They're in 60%. Now these are way high compared to the equity markets. The equity markets these days, with all the quantitative easing and everything like that, we're seeing, barely into the double digits. So there's not a whole lot of meat on that bone, but these are massively inflated compared to everything else that's out there. But still, just a month ago, these were sitting at well over 100%. So what that implies is that's the annualized volatility going forward. It could be a plus minus 100% from here. So now it's only down to 64%. So we were selling about a month ago into the big volatility spike and getting some great entries for that. So lately, the move from a couple of days ago hasn't been so good. So the question is, can we set something up, can we set up an order down here to sell in an implied volatility spike of maybe 110% or something like that? Well, you can. The problem is that, at least this is the way I read it, is that you can't enforce what type of a credit that you're going to receive. So you're either going to key on a limit for the amount of BTC or the amount of dollars that it brings in or the implied volatility. So you can't say, well, I want to sell at 110% volatility, but I want to make sure I get at least a 0.04 BTC credit. It's not going to work. I don't think they can do an and condition in there. That's the way I read it. So I typically am just going to use the tools in something like skew.com where we're going to see a relative spike in implied volatility. I'll sell into that relative spike in implied volatility, and then I've got a certain credit that I want to receive for this. I want to get at least, a 3% return on these things. If we're going to hold into something for 30, 40 days or something like that, make sure you get paid for the effort. Okay, so that's implied volatility based. That's implied volatility based. Okay, so let's go back to our thing here. And the next one that we have is managing option exits. The first thing that I do before entering, now the options trades that we're doing on here are just simple. We're selling puts. We're selling puts to open up an entry, which is like selling insurance. It's like selling an insurance policy. We're selling put options with the idea that we want to get paid for that pullback. And then if we want to rent out our BTC, we can sell calls. BTC, or actually Ethereum as well too, we can sell calls against that. And it's like, the selling call analogy is like you own an apartment building and you're actually renting out units to tenants instead of just owning and looking for capital appreciation on that. So just simple option trades, very simple. We'll get into more complex option trades when we get better interfaces, better liquidity, better spreads, more volume, more open interest, better granularity on the strike prices, all kinds of things like that. But for right now, we're limited to very rudimentary types of option strategies. So the first thing I do is figure out what my exits are. Don't enter a position until you know what your exits are going to be. Don't be like everybody else and just like throw it on, slap it on, and hope for the best, because you know how that's turned out for you so far. So what I'll do is I'll figure out what my profitable exit is and then my stop exit. Okay, it's pretty simple. It doesn't take more than 30 seconds. A profitable exit will either be, I'm going to let this option expire worthless for full profit. I'm totally confident in this, that the price is going to stay above this level and I just want to ignore it. Or it can be, I will close down the position once I burn off X% of the trade, which is what I think most people should do. Start off at maybe like 50% of potential profit, get some confidence, learn how to execute, and then you can start to become a little bit more aggressive. So it's best to determine that in advance. However, if something fundamentally changes with the chart, it's okay to close if profitable. Right? So in other words, if all of a sudden you wake up one day and all of a sudden the market has fundamentally changed, like September 27th, the market certainly fundamentally changed. It went from range contraction to range expansion, moved to a different form of volatility. So it's okay to close if you're still profitable. If you're underwater, it's never okay to say, I want to take less of a loss than I would if it, because what you'll find is that if you trade these correctly, it's not okay to make emotional decisions like that. So I use price-based mental stops because option stops are notoriously unreliable. They are unreliable. Even in perpetual contracts, they're unreliable. So what I don't do is I don't set up with options, with simple options. What you never want to do is set up a stop like you're going to buy a call and you hope it goes up like this, and then if it goes down, you've got a stop price on there, because guess what? Even in the middle of a little pullback like that, you'll get stopped out if you're going to stop based on the option price. All it takes is a little jig to the downside and you can get knocked out of it. A very good trade. Okay, so option stops, don't do that. We've known this for years. They're notoriously unreliable. They will fire on you when you least expect it, and you'll have no recourse for that. You can't go back to the broker and say, yeah, but I didn't want it to go fire. The price didn't come down that much. It doesn't matter, because option prices will float based on price, time, and volatility. Any combination of those three, making a change and hitting your stop, means you're bye-bye. Okay, so set an alert on my chart to inform me of price level failure. So if I set up, so let's say maybe we get a nice pullback here and I'm going to sell a put option down here and say, here's my put. I'm going to say, as long as the price doesn't get below a certain level here, as long as it doesn't come down and attack me and go below a certain level, I'll stay in the position. Now you can be really super aggressive and say, as long as the price doesn't touch my short strike, then I'll stay in it. But that's more aggressive, but that'll keep you in longer. So it's kind of half of one, half a dozen of one, six of another kind of thing. So pick the method that works best for you depending on how aggressive you are. Okay, let's see, what do we have? Now, some of you may be saying, I'm not an Omnia member. So for you Omnia members out there, you guys are awesome. Thanks for showing up today. If you're not an Omnia member, if you want more information like this, then we've got this cool sale going on. And what I'm referring to is on the right-hand side. So if you go to this website here, readysetcrypto.com/sale, you can get into 3 months of Omnia for $66 a month. So that's a one-time or once every 3 month subscription of $199, and that gets you in for $66 a month. So 16% off versus the street price of $79 a month. So consider that, if you will. And we also have a brand new class that just came out. This is Mavs Baby, the financial freedom class, 101 steps to your financial freedom. I put 14 modules into this one myself. Okay, we actually have a class with 101 steps to it, 101 separate modules to it. It's extraordinarily comprehensive. And for $47 is a hell of a value. And it's available for Omnia members, included with your subscription. But for $47, you cannot go wrong for this if you're not a member and if you just want to buy the class. Okay, that's all I want to talk about now. The next topic is Deira Bet Perpetual Exits. So I got a question in the last day or so here from somebody saying, hey, I'm trading the perpetual contract, and I want to know how to set up not only a profitable exit, but also a stop. Now, let me show you something that I haven't done this for a while, but let me show you. This is TD Ameritrade, Thinkorswim. And this is the NASDAQ futures. This is what I typically will trade during the mornings, afternoons, things like that. What I want you to do is to look at the right-hand side of this. So this is what's called a ladder interface. Deira Bet does have a test account. So look at testnet.deirabet. Just Google testnet Deira Bet. You can get a Deira Bet testnet account. And you don't even have to be, you can be from the United States and they'll still let you sign up, I think. So this is what's called a dome or depth of market or a ladder interface. It's called many different things. But notice that if I have my price, if I put my cursor below, this is where the current price is. You can see this thing kind of, squirting up here. Okay. Looks like we get a long signal coming. So I could either do a buy stop and take myself into this. I can take myself into this trade. Don't want to do it right now because I don't want to have to manage a trade. But if I did a buy stop here, you can see that I've got a trigger +3 limit above there on the right. And that will sell off. That's called one cancels other. That will sell off my first contract. And if you see, down there at the lower right, it says trigger -7, stop, trigger -7, stop. Both of my stop contracts are 7 points below. Both of my stop contracts are 7 points below. So if I trigger one of the exits on the upper right, it'll take off one of the contracts. And then what I have to simply do is move my, kind of drag my stop up and manage that. So this is the way that futures traders have been trading for decades now. This is the way that Digitex is proposing to put out an interface. This is the way it should be done. But it's not the way that the world trades crypto futures. What they decided to do is to take kind of the Forex model of things, which is, in my mind, not as good. So this is the way it should be done. And this is the way, because it's a one-click entry. It's a one-click entry, and then I've got a bracket in here. Once I enter a position, I've got what's called a bracket, right? I've automatically got a stop down here, and I've got a limit up here. And I've bracketed in the trade. I can walk away. I can take the dog for a walk. I can do whatever. The price is going to do whatever it's going to do. And you can be very mechanical about it. That is a bracket order. It looks like I should have taken a long there. So that again is, so when we're looking at Deira Bet, let's go out here to, let's go out to Deira Bet. And we've got our perpetuals up here. So this is our little perpetual contracts. And so, oh boy, yeah, this totally blew through here in the last few minutes. So this morning I set up, let's see, what's my order, my trade history down here. So this morning, let's see, this is UTC, so 15, that would have been, gosh, I don't know, 10 o'clock this morning, my time. Oh, no. That would have been 9 o'clock this morning, my time. So 9 o'clock, I set up a long, and it fired about 2 hours later. So I got in at 76.30, out at 7,700. So what I did was, and I wish this had not fired yet, but what I did was I entered long here at 76.30. So there's the long, okay? And I wanted to set up a limit sell at 7,700. And that's above the price since I went long. And here is a limit, or no, a stop sell would be down here. And that was at, let's see where it's at. And actually, quite honestly, it's still there. See, this is the problem with this type of interface, is I now have a stop sell order sitting there. If the price does this, if the price does one of these, it takes out my limit order up here and then comes down to 7,600, I'll get filled on a short position. Bah, that's not what you want, okay? This has happened to every single person that's ever traded without a one cancels other bracket. They put in a limit up here and they put in a stop down here and they forget to tear down the interface. You will get filled. The price, the volatility will come down and get you. It's happened to everybody I know. Okay, so what I have to do now is I have to get rid of this, clean up, stop order canceled, sell BTC perpetual is now gone. Okay, so let's assume that I did have a position. How do I set up a stop and a limit on that? So if I buy to open, then I need to sell to close. If I buy to open, then I need to sell to close. So if I want to put in the stop, what I do is I go over here to more, and I can do a stop market or a stop limit. Now let me explain the difference between the two. A stop market, let's say my stop is down here at 7,600. A stop market says when you touch 7,600, that's the trigger price, whatever the market is at that second, you're out. So I may set this stop for 7,600. I may find that I get out at 75.98 or something like that. I can't control what my actual exit cost is with a market stop. However, if I do a stop limit, what happens is when 7,600 is touched, it triggers a limit order. And then you can define your limit order at that point. And a lot of people, what they do is they say stop at 7,600, limit at 7,600. But the problem is if the price comes cruising down here and just blows through there, you could be sitting there, you could be triggered and waiting for the price to come up to 7,600 again, which is why this one is a little bit more aggressive and may disappoint you, and this one is a little bit more conservative, the stop market. However, you may get some slippage on that. So that's how you set up your stop. Now, the way that you set up your target is, again, you're going to set up a limit. And this is where you're going to set up, this is where I set the 7,700 limit this morning, which is the one that fired. All right, so if I go down to trade history, 7,750, that's the one that fired. So that's the easy part. Make sure that your limit is not below If you're going long, make sure your limit is not below because you'll be fired immediately. Handy, is this trading 101? No, this is called Trade School. These are Omnia members that had specific questions on how to use the Deira Bet interface for trading perpetual futures contracts. And it can be confusing. It's easy to get into a trade. It's a lot more difficult to figure out how to set up a bracket. So I showed you guys the difference here in terms of, I showed you the TD Ameritrade ladder interface. And once you learn a ladder interface, you'll never go back. But the problem is we don't have a ladder interface here on Deira Bet, so you have to build your own. You have to manually put it together. Unless I see something on here that says one cancels other, which I don't. So this is what you have to do. But thanks for your question. Okay. Let's see if we have anything else here. I've just cleared the deck, so I'm going to open it up to anybody else that has questions for right now. So we covered the question about the test account with Deira Bet. John, can you show how to calculate 2 standard deviations? Well, easier way to do that is, I used to know, I've forgotten how to do that. Quite honestly, I just use 1 standard deviation. What you can also do though is, if you want to do something like this, what you can do is, like, if you want to go out to 27 December, put on your delta, and then look for a 5 delta. A 5 delta, let's see, where's our delta here? Here it is. 5 delta, like 5,000, this is about 2 standard deviations. That's a 5%, it's got a 5% probability of getting there, and it's about 2 standard deviations. That's close enough. Okay, any other questions? Any other questions coming along here? We've gone about 50 minutes here, so we're pumping hard, man. Let's take a look at the price. Oh, look at that. Holy cow. This is almost what I was looking for here, guys. We're smoking. Look at this thing go. Okay, let's go out to a 1-hour chart. So did Zuckerberg go back to Congress and say that Libra is going to be... This is really nice, guys. I like this. Look at that. In the last... Now, I can't take credit for this. This is not me. You guys always claim that I crash Coinbase every time that I get on one of these things. So this is not me doing this. This is what I'm looking for, though, because everybody's... Wow, this is like smoking, man. If we get above 8,400, this could be the short covering. Now, I want to see volume on this today. I want to see Mongo, big time volume, and I want to see it close near the highs of the day. And what they may be trying to do is they may be trying to gap on the CME. So don't forget, guys, that CME futures stopped trading late this afternoon, Eastern time. And there's the gap that occurs over the weekend because those guys weren't smart enough to specify a 24/7 contract. So there's always a weekend gap that occurs, and the market loves to toast those guys. We now have just printed a higher high. We just took back everything that happened on Wednesday plus some. This is amazing, all right? Too bad we didn't sell into that dip, but there was no implied volatility to sell into it. So nice smoke and move. I love this, guys. There's got to be some kind of news behind this. Okay, any last questions here? You guys are probably wanting to trade this. So, holy BTC pump. Woohoo! All right. Hey guys, I'm gonna vacate here, and I want to wish you guys a great weekend. I'd like to thank everybody for joining us here on the Public Trade School. Don't forget, if you want to join us for Omnia, you guys have that. Let's go back here. Don't forget, we have ReadySetCrypto.com/sale. So an easy to remember URL to join us. And we do this every week. So plus we also answer your questions, and you got a great bunch of Omnia people to hang out with as well too. And the new class is readysetcrypto.com/freedom. Freedom. Think of Mel Gibson saying freedom. All right, everybody. Thanks for hanging out with me. Appreciate it. You guys have a great weekend. All you boys and girls out there, take care. See you guys.